Sean, we saw a little bit of a pullback in US equities after a very strong day to start the year. I guess volatility is the name of the game. Is that going to be one of the key words heading into 2022?
I'm afraid to say it is. I think we've had a year and or so of markets just focusing on returns. But as we saw in the last sort of trading out in the United States, commentary towards actually reducing the balance sheet in the United States is bringing about now a steepening of the curve, a bear steepening. So this flip-flopping between bear flattening to bear steepening, I think is going to induce a greater deal of volatility and, of course, naturally uncertainty. And that, again, is something perhaps we've not experienced for the last 12 months, and certainly not for this cycle. So yes, it's return per unit of risk that's going to be uppermost in people's minds for 2022.
So what do you think would be a reasonable level of equity return to round out 2022?
Well, I think it does vary by region. I think for the US, I think flat returns probably are going to be pretty much the measure of the game if the 10-year Treasury gets up to about 2%, given the sort of valuations that we have in the US. Perversely, I think Asia does reasonably okay because in many parts, the steepening of the yield curve is actually quite good news for places like Japan, Korea, Taiwan, and Australia. They have a large representation of banks and financials, and that US steepening of the yield curve tends to be transmitted almost perfectly into their financial systems as well. So I don't think it's necessarily as bad as for Asia, perhaps as it is for the US. Europe will come out pretty well. Rising inflation and a steepening of the yield curve. European equity markets are packed with financials and cyclicals. And again, I suspect Europe is probably in for double-digit returns this year after a pretty stellar year last year.
Of course, all of this depending on where inflation goes, right? And we heard from the Minneapolis Fed President Neil Kashkari today talking about how that low inflation regime could return. Take a listen first.
Once the COVID shock passes and things start to go back to normal and workers fully return and demand goes back to normal, I don't see any reason why the economy wouldn't revert back to the low inflation regime that we've been in for 20 years.
Do you buy into that narrative, and what would that mean for yields?
I have to say I don't buy into that narrative. It's very coincidental about those comments because on Monday, we did some analysis about how much the share of labor is taking from profits. And really, we turned around back in 2019, 2018 during the China-US trade dispute. And for the first time in 50 years, the share of labor relative to profits had actually picked up. So we're coming in now into a period of time when the demand for skilled labor is insatiable. So I don't agree with those comments. I think we're going to see labor taking an increasing share of the profits, and hence inflation rates are going to remain much higher than people would have anticipated.